Selling your second home, tax and legal considerations. Selling a secondary home in the United States involves a different set of tax rules and legal obligations than selling a primary residence. While a primary home often enjoys significant tax exclusions, a secondary home is generally treated as a capital asset, making the owner liable for taxes on the appreciation of the property's value. Point 1 of the most critical tax considerations is the application of capital gains tax. Unlike a primary residence, where individuals can exclude up to $250,000 or $500,000 for married couples of profit from taxation, second homes typically do not qualify for this Section 121 exclusion. For 2025, if you have held the property for more than 1 year, you will be subject to long-term capital gains rates of 0%, 15%, or 20%, depending on your total taxable income. Short-term gains on properties held for a year or less are taxed at your ordinary income tax rate, which can be significantly higher. Beyond federal capital gains, high-income earners must account for the net investment income tax. This is an additional 3.8% tax applied to investment income, including the gain from a home sale, if your modified adjusted gross income exceeds specific thresholds, $200,000 for individuals or $250,000 for married couples filing jointly. This surtax can catch many sellers off guard, effectively raising the top capital gains rate to 23.8%. To minimize the tax hit, sellers must accurately calculate their adjusted cost basis. The basis is not just the original purchase price. It also includes closing costs from the initial purchase and the cost of capital improvements made over the years, such as a new roof or a kitchen renovation. However, routine maintenance, like painting or minor repairs, cannot be added to the basis. A higher cost basis reduces the realized gain, thereby lowering the total tax bill. If the secondary home was used as a rental property at any point, depreciation recapture becomes a significant factor. While the IRS allows you to deduct depreciation to offset rental income during ownership, those deductions must be recaptured and taxed at a flat rate of 25% upon sale. Even if you did not actually claim the depreciation on your tax returns, the IRS often calculates the tax based on the amount you should have claimed, making this a complex and often expensive legal requirement. From a strategic legal standpoint, some sellers look to a 1031 like-kind exchange to defer taxes. This provision allows you to sell an investment property and reinvest the proceeds into a like-kind property without immediate tax liability. However, strict safe harbor rules apply to second homes. To qualify as an investment property rather than a personal vacation home, you must have rented it out at fair market value for at least 14 days a year for the 2 years prior to the sale, and your personal use must have been limited. Sellers should also be aware of the potential for state-level taxes and withholding requirements. Many states impose their own capital gains taxes, and some, like California or Maine, may require exit taxes or mandatory withholding at the time of closing if the seller is a non-resident of that state. These requirements vary significantly by jurisdiction and can impact the immediate liquidity available to the seller after the transaction closes. Finally, proper legal documentation and reporting are essential for a smooth closing. This includes ensuring a clear title, addressing any local transfer taxes, and accurately completing IRS Form 1099-S. If the property was held in a trust or LLC for liability protection, the legal sale process may involve specific entity-level resolutions. Early consultation with a tax professional or real estate attorney is highly recommended to ensure all 2025 regulations are met and to avoid costly penalties. We welcome you to subscribe to our YouTube channel for more informative videos on real estate and finances. Thank you.